Let's look at U.S. December's jobs labor numbers. These will pretty much drive or stall the U.S. stock market now. So December last year, labor market ended at a soft note. 50,000 jobs were added, compared to 56,000 in November. Then, the stock market futures gained a little after the release of this report, and the prior months were revised downwards. Both November and October saw numbers revised downwards. Looking at the chart at the right, this is a trend. Pretty much right now, fewer people are concerned about inflation. Everyone is more zoomed into the labor market, and it is not looking very strong like compared to previous year. So at the last point here, for the full year, 2025, the average gain was about 49,000 per month, compared to 2024, which was more than 3 times at 168,000. Unemployment rate for December dropped a little. It's at 4.4% now, from 4.6% in November, and then hourly earnings, wages, is at 3.8% year on year, still quite a decent amount above inflation. So the conclusion is US is pretty much in a hiring recession. There is a boom going on, like from what you see, the stock market and growth is still there, but just not the jobs. A lot of it have been taken by AI. And next, everyone is keen to know the full year GDP of US. The current early stage data is pointing to a Q4 versus Q4 year on year of 5.4%. Everyone is waiting to look at the full year, January to December number. To wrap everything up, it's still more or less pretty okay and stable for the time being. And next, Trump's recent plans on U.S. mortgage and making it more affordable for people to own houses. Trump instructed representative, unclear of who exactly, but most likely Fannie Mae and Freddie Mac, to buy $200 billion worth of mortgage bonds. This will inject more liquidity to lenders and eventually bring down both mortgage rates and monthly repayments. Currently, Trump say that these two are sitting on a pile of cash. And zooming into the latest available data balance sheet of the third quarter last year. These are the numbers. They have billions in cash and cash-related liquid assets. So then after this, stocks of mortgage-related companies all gained. Rocket companies, UWM, PennyMac, and more. Some comments from Bank of America. This will bring some relief to home buyers. For every quarter-point drop in mortgage rate, for a typical 30-year fixed loan of $400,000, monthly payments could drop by $70. And the chart at the right, this is the 30-year fixed-rate mortgage on average in the U.S. You'll see that over the years, the rate is quite high. That's why Trump wants to bring it down. These are good news for consumers. When consumers pay lesser in mortgage, they'll have more spending power. This is quite an important thing for U.S., given that consumer consumption contributes a huge role to U.S. GDP. It's about 2/3. And Morgan Stanley and Barclays both commented on the mortgage-related lending companies, UWM, Rocket, and PennyMac. For some background, Fannie Mae and Freddie Mac are both government-sponsored entities. Both of them are around to ensure a reliable and affordable supply of mortgage. They buy residential mortgage from the lenders. Then they either hold it or sell it as mortgage-backed securities to investors. The lenders will get the money and are free to issue more mortgage. This rotation of loan and cash brings more liquidity and stability and also more affordability in the housing market. Now on to Euro area. December inflation dropped to 2%. November was 2.1%. This is exactly at their 2% target. In looking for the next few months ahead, inflation should soften more because of the strong euro, lower energy prices, and a slight deceleration of wage growth. But however, in the longer term, because EU, especially Germany, will roll out fiscal stimulus, which will boost economic growth. People are expecting this to push up inflation eventually, but not so soon. For the time being, expectations are that there will be no interest rate cut for the EU area. Currently, the sentiments aren't very strong. Look at the chart here. You can see the trend. Yes, it's picking up, but it's not showing any meaningful signs of pickup. Industrial sentiment somewhat improved, but new orders are still lower than in October. And demand for services is also not very good. All these will weigh on Q4's GDP results. Consumer confidence declined. Look at the chart here. The trend has been in negative zone. There are growing concerns with unemployment, especially AI is expected to take away more jobs. Some comments here. After fiscal stimulus and more investments, then very likely consumer spending might pick up. And now, an overview in China. Inflation towards the year picked up. December CPI currently is 0.8% year on year. Now, if you see this on the surface, you might think, oh, this is good news, but you need to dig in deeper. The pickup in consumer prices is not really because of a recovery in consumer spendings. Consumption is still not there. This has been the problem since many years already in China. The recent pickup in CPI is because of the bad weather. And so then there's a shortage in vegetables, so prices went up. And also gold prices surged a lot. It went up almost 69% year on year in December. Now, when you strip out the volatile prices of food and energy onto the more stable one, core inflation went up 1.2%. But some will argue that it's partly because of gold and possibly semiconductor prices. Producer prices still aren't very good. Look at the chart at the right. It's still at the negative region, even though it picked up from negative 2.2% and landed at negative 1.9%. Producers have been in deflation beyond 3 years because consumption is weak. So similar companies embarked on price wars and hope that volume will overwrite by selling cheaper. But this isn't really helping them. It's eating into their margins. So, to wrap everything up, yes, China is still very likely on track to get the 5% GDP growth target or at high end of 4%. But still they haven't recovered from deflation. And consumers are still reluctant to spend. 2 main reasons: the uncertain employment outlook and property crisis. A typical Chinese retail-level portfolio, about 50% of it goes into real estate. So when they see their portfolio dropping a lot, even though it's paper loss, but still seeing red, they get more conservative in spending on big-ticket items. So inflation is far from the 2% target. This also shows that the stimulus so far has done little to improve things. Now the government said they have plans to improve this, but the full details will only be issued in March this year.